All right, welcome in. I thought we'd try something a little bit new today. I'd like to introduce one of our analysts. This is Taylor Reed. He covers the Bakken, the Rockies, and anything I don't want to do for us. Um, so, um, yeah, there have been some announcements on some expansion capacity out of Canada that potentially will impact the Bakken and the Rockies, which he covers. So we've had some discussions about that. And I thought it would be good to introduce him. He'll be doing more content in the future. So do a video together and discuss some of the implications for some of the announcements. So with that said, I think we can dive right into it. So switching to my map view, what I have up here is Enbridge's Canadian Mainline here, their Lakehead system, which comes into the US, as well as Dakota Access Pipeline. So really there were three announcements over the last month that I think are pretty important and could have implications for not just Canada, but potentially the Bakken and also the Rockies, ripple effects as the barrels slide down and shift between different markets. So the first announcement that I think is pretty important was Mainline Optimization 2, which Enbridge announced, a project that would expand this mainline 250,000 barrels a day. So they've already FID'd or made final investment decision on Mainline Optimization Project 1, which would take barrels down into the Midwest. Some of those would end up in the Gulf Coast via Flanagan South. This is the second phase of that project, in which they've said that it's going to be a project that pushes barrels down to this area, and then moves barrels into Dakota Access in some way. Now we believe that there's probably new pipe that's going to be laid to do this, although there are some Enbridge pipes that they could reverse and push some barrels down there. But if they're going to do what they've talked about is the 250,000 barrels a day of capacity, they're probably going to be a new pipeline built between these points. So they could build the pipeline between Regina here and get to DAPL, the Cromer area here and get to DAPL. All of those are options to feed Canadian barrels into DAPL. Now, why is this important? Well, it's important because Canada needs more egress capacity. I'm sure a lot of you have heard the talk of new pipelines in the future. Canada is a growing market. We've talked about that. And expanding these pipelines more downstream to the Midwest and then using Flanagan again to the Gulf Coast is really expensive. Those pipelines are largely full. So why not utilize another pipeline that has latent capacity or spare capacity on it, like DAPL? It makes total sense. So that was the first announcement that I think is pretty important. On the heels of that announcement, DAPL announced that they were going to put out an open season for recontracting or just new contracting on DAPL. So DAPL came online in 2017. It had primarily 7 and 10-year agreements. Those 7-year agreements at this point have likely all fallen off. The 10-year agreements, if we fast forward to 2027, mid 2027 is kind of the time frame when those are falling off. So they are giving the Bakken producers the opportunity to recontract their capacity before they start shoving Canadian barrels down this pipeline. So it introduces a little bit of leverage for DAPL to say, hey, we are planning on moving Canadian barrels down this line. And it introduces a risk to the shippers for Bakken that, hey, if you guys want to have your barrels taken care of, then you'll need to recontract with us. So that was announcement number 2. Announcement number 3 was by a competing pipeline out of the Bakken. And I thought that was really interesting. And I'll let Taylor talk about that one. And then I'll chat with you guys again toward the end here.
Thanks, Matt. Sure. Yeah, that announcement is pretty interesting. It's by Bridger, and if you take a look at my screen, one of the things that I wanted to talk about was this announcement. Basically, is looking at extra capacity coming in on this pipe, and we've talked a little bit about this in the past, and I want to level set everybody. So first off, there will be some interim capacity coming online in January 2026. We don't know when the full expanded capacity, and we don't know what those capacity numbers will look like. But if you take a look, we basically have this northern section up here. We have the southern section down here. We call the supply and market segments. Their capacity numbers are around 315,000 and 350,000 barrels per day, respectively. Then we look at this middle section, which is where we had previously identified the bottleneck. And this section could be expanded with extra pump stations or possibly laying new pipe. And, so we'll talk a little bit about that. But if you're interested, I encourage you to go and read the Plainview Weekly, where we talk about this more in depth. So what I want to do is I want to pull us out just a little bit and look at egress options out of the Bakken. And so let me change my screen here. And what we're looking at here, as I level set y'all again, is the blue line is what's currently flowing, and then the orange section is the potential capacity of each of the pipes. So on DAPL, you can see we've got a little over 500,000 barrels right now, and over 200,000 barrels of capacity. With Enbridge's North Dakota line, almost no capacity. With their Bakken line, they've been recently filling the pipe up a little bit, but it's still some capacity that heads up into Canada. And then Bridger, as you can see here, is almost filled. Now on the far right, we have the Double H pipeline, which recently converted to NGLs, and so as a result, we lost a little bit of capacity here. So if we look over at our next slide, this is basically going to show you all of the different pipelines stacked together in terms of what they're flowing, and then also our capacity number at the top. So as I point this out, we got a little bit of an expansion here by DAPL back in 2021, then another expansion, a smaller expansion by Bridger, and then here we go. We're starting to see that capacity out of the basin is starting to get lost just a little bit. So let's zoom back in.
That last reduction is due to the conversion of Double H, correct, Taylor?
That's correct. That's thanks for pointing that out. And so then that happened, I believe, in October. So if we
hey, let me stop you. Let's go back to those slides again really quick and go to the first one.
Sure.
So what's interesting to me, actually, let's go to the second one. Let's talk about that one quick. This is not a chart that you want to see if you are a pipeline looking to recontract capacity on your pipeline. So I've seen worse, certainly in the Eagle Ford over the last 6 years, that the gap between the capacity of latent capacity or extra capacity on the pipelines versus what the flows are. The Eagle Ford was worse, but this is not great because you have pipelines with excess capacity, which are able to compete, which are going to compete with one another on rates to try to get pipes or try to get flows on their pipeline. So what's interesting about the Bakken, and go to slide 1 here, is you actually, even though you do have a decent chunk of capacity open, you don't have a lot of actual entities that control that capacity. So really there's only 3 here. Double H has gone away. It's not carrying oil anymore. So you only have Bridger, Enbridge, and DAPL, and Enbridge is a partner on DAPL. So, I mean, I'm sure they'd love for as much barrels to go on their own 100% owned pipes as possible, but they also get a chunk of the upside for DAPL flows as well. So it's kind of an interesting dynamic in recontracting and thinking about recontracting. We've talked previously about the Permian recontracting and how if there's excess capacity there, that could be very competitive and bring down rates. This is different because there's just not that many players here competing. But we'll talk about that more. But go ahead, Taylor. Continue.
Sure. And all I wanted to do was basically turn our attention back to the portal and let's take a look at DAPL real quick in terms of the flows. And so I have those pulled up right here. And all I want to point out here is that DAPL's been steadily falling for about the last year or so, with the occasional uptick. And so they've gone from about 680 to to a kind of a low around the low 500s. So if we compare that to Bridger, you can see that there's actually, while DAPL's been losing barrels, Bridger's been gaining some barrels. And so I do want to turn it back over to Matt so that he can talk a little bit about why that's occurring.
Yeah, so there's some competitive dynamics that have shifted, and I'll pull up some just a quick slideshow to kind of go through that. So to understand what has changed between when DAPL came online in 2017 and today, we're going to do like a netback analysis. So it's pretty simple. I'm using round figures. These aren't 100% accurate. Exact commitment levels matter. There are some discounted prices here and there for different shippers. But if we look at what the netbacks were between Bridger and Pony Express here, so Bridger and Pony Express had and have a joint tariff to get Bakken barrels to Cushing. So they're shipping those barrels there. And if we look at where DAPL's shipping their barrels, they're shipping them to the Patoka area here, and then the Gulf Coast area here. So those are the two markets they're shipping their barrels to. And if we look at 2017 and we'll use a theoretical price that'll be the same in 2017 versus today, just to make it easy. But assuming a $60 barrel at Cushing in 2017 and then a joint tariff rate, that's about what it was, $6.50 on Bridger and Pony Express to ship your Bakken barrel to Cushing. A shipper was getting a net back of around $53.50. If you look at what DAPL was, and we assume a little bit of a premium pricing market in Patoka of $1 over Cushing, we assume a premium pricing market in the Gulf of $2 over Cushing. You can see the netbacks are superior taking DAPL, and that's because number one, the premium pricing in these markets, and number two, the lower tariff rates. So pretty self-explanatory. The better pipe, the more economic pipe back then was generally DAPL for most shippers. If we fast forward to 2025 or to today, that has flipped essentially. So let's start with Bridger and Pony Express. The big change here is they've dropped their tariff rates in an effort to be more competitive with DAPL. They've reduced their tariff rates. So now the same net back or the same tariff is, instead of $6.50 is $5, and you're getting $55 for your net back. At the same time, DAPL's rates have increased. So you can see in 2017, they were $5.25. 2025, they're $1 higher for both routes. So you're looking at, and the increase is just the inflation factor that they have tied to their contracts that allow them to raise the price a certain percent every year. And that's happened over 8 years. That price has gone up over time. So the other dynamic that has changed, you'll notice the Gulf Coast price in 2017 was 62. That premium market has weakened a bit, and you only have a $1 premium there. So the netbacks that you're getting today shipping on Bridger and Pony Express are higher than the netbacks that you're getting on DAPL if you're a shipper. So if DAPL, let's say if Bridger wants to do this expansion and if they have open capacity, if DAPL holds their rates like at where they are today at the $6.25 and the $7, I think they're at risk at losing some barrels. Now, there are some caveats. Shipping into Cushing is a little bit dangerous. You do run the risk of Cushing becoming constrained and you getting discounted significantly versus a pipe like DAPL that can go to, which are more liquid markets, especially the Gulf Coast is a much more liquid market. The Patoka area may not be more liquid, but it's certainly an area that has a premium price as the refiners try to get the barrels there. So I think those are important dynamics to think about is, as Taylor showed, Bridger has been taking barrels. I would imagine some of those barrels might be 7-year shippers that their contracts rolled off. They looked at the netbacks and said, hey, it's better to ship our barrels down Pony. So in recontracting, the dynamics of, hey, there's Canadian barrels coming online, but we have a Bridger expansion that we could ship down. Does it make sense to take Bridger or Dakota Access? Does Dakota Access discount its rates in this recontracting? Those are things that we'll be interested to see. And I'm going to flip back to this really quick, and I'll just talk about some of the dynamics of Bridger expanding really quick, and then we'll wrap up. So I'm going to bring on Pony and Bridger. And I'll turn on my draw thing here. I won't belabor the point because we've talked about it. We do think that Bridger can economically expand down to Guernsey. They will have to spend some money to do that. They may have to lay some pipe. But getting to Guernsey, I think that they could economically expand up to 200,000 barrels a day. The question becomes, what do you do with the barrel once it gets to Guernsey? So there are some pipelines with open capacity. Platte has open capacity that could take it this way. Cheyenne pipeline could take it down to the DJ. Suncor has a pipeline that could take it down to the DJ. And if you're going to the DJ, you can get on pipes that have extra capacity on them. So no CapEx outlay if you're going to feed those pipes. Grand Mesa has excess capacity. White Cliffs has excess capacity. So those are DJ pipes that you could feed these barrels into and get them to Cushing. As Taylor mentioned, I believe Bridger did mention that they have a downstream partner that they're planning to expand with. We don't know who that is. We know they have some sort of an equity interest in Pony and Seahorse. This Pony and Seahorse are the same pipe. Do they plan on expanding that? Pony has some space. Let me just clear this out quick. Pony has some space between these 2 points here. But once you get to this point, this is a singular pipe. This is largely full in our view. So if they're going to do a large scale expansion, you probably need to lay pipe here, which is going to be really expensive. This is a really long route. So this is the play, the play between like how economically can they, what tariff rates can they offer on this expanded capacity? Are they able to stick to that $5 tariff rate, or are they going to have to put so much capital into this project that they're going to have to actually raise their rates? So those are things we'll be looking at. And does DAPL even try? How hard does DAPL even want to compete? If they have Canadian barrels that are going to be filling their pipeline, do they really care that much to lower the rates significantly on their Bakken volumes? Those are questions we'll be looking at as this goes on. Anything to wrap up with, Taylor? Any other things that?
No, I think we covered
like
it.
to mention? Okay.
No, I think this has been this is a really interesting dynamic that's going on here, and I can't wait to see how it plays out.
Yeah, we'll see. Taylor will be doing more content, so don't be surprised if you see him on a video and it's not me, it's him. So with that, we'll wrap up. I hope everybody has a great week, and we'll talk to you next week.